Welcome to the first episode of Elliott Wave Revealed. I'm Jeff Huge. I'm the Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights, an investment strategy and trade analysis boutique. We are launching a new educational series designed to help our viewers understand a time-tested approach to market analysis that dates back to the 1930s, known as the Elliott Wave Principle. It's our goal over the next 20 minutes or so, and we'll take a look at our table of contents here so you can get a quick sense of what we're going to talk about as we introduce you to the Elliott Wave Principle. Our goal over the next 20 minutes is really to build a foundation of basic knowledge on the subject by looking back at the history and the theory behind the Elliott Wave Principle. We hope that at the end of this presentation, our viewers will have a basic grasp for the general nomenclature and terminology associated with theory and how it's applied to market analysis. And so this is really going to be the first in a monthly series on the subject of the Elliott Wave Principle. And in future episodes, we plan to do a much deeper dive into Elliott's rules and guidelines for wave formation and all the nuances that are necessary to understand in order to correctly identify these patterns and apply them to your process of market analysis. So to begin, we're going to start with just a quick look at the history and theory of the Elliott Wave Principle. The theory itself was actually developed back in the 1930s by an accountant by the name of Ralph Nelson Elliott. He went by R.N. Elliott in terms of all of his publications, so he's widely known as R.N. Elliott. He wrote a book back in 1938 called The Wave Principle. And in that book, Elliott went on to basically describe an understanding of the market that was relatively new. Elliott was a student of Charles Dow's theory, and he was a very, very strong proponent of the Dow theory. His career as an accountant actually took him south of the border down to Mexico, where he was accountant for several major railroads at the time. And while down in Mexico, he contracted some type of a malady that was described later as kind of a severe chronic case of anemia, which kept him bedridden for a while and confined to basically a rocking chair on his front porch in California, where he lived out the rest of his days. But while he was kind of in that condition, he had a lot of extra time on his hands. And, he spent that time really kind of painstakingly going through this history of the Dow Jones Industrial Average through old newspapers and chronicling price action day by day by hand. And so what he ended up doing when he produced this initial publication, his book or pamphlet known as the Wave Principle, it caught people's attention. And he was invited to write additional articles. And I believe he wrote as many as 12 additional articles for a publication known as Financial World Magazine, where he really got into the depth and detail of his method for market forecasting, and which really kind of took these painstaking observations and the classification of this 75 years of empirical data and laid it out in no uncertain terms as how to forecast the stock market using his strategy. And so in short, what has since become known as the Elliott Wave Principle, it's really an interdisciplinary framework that's built upon concepts from fields that we would now call behavioral economics and fractal geometry. Back then, one might have called them psychology and mathematics simply, but they can be used to identify self-similar patterns in the price action of most publicly traded securities, as well as the broad market indexes. And the point of doing that is in order to make probabilistic judgments about the current future path of prices. Now, let me emphasize probabilistic judgments. This is not physics, okay? It's not something that we know to be certain at each time. What we know is that there is a high probability of the next phase of the wave formation to carry out in a specific way, because the history is that these are repetitive patterns. And so with that, let's dig a little bit further into kind of the basic theory itself. So what Elliott discovered is a structural design in the ever-changing path of the stock market that basically in turn reflects this harmony, a basic harmony that's been found in nature. And every market decision is both produced by meaningful information and also produces meaningful information. And therefore, each transaction that enters the fabric of the market, it represents both a cause and an effect that is communicating transactional data to other investors in real time and influencing their behavior. And this feedback loop is governed by human social behavior, and that process generates forms in the market, right? And those forms are repetitive and they have predictive value. That's basically the crux of Elliott's theory. What Elliott then went on to do is to isolate 13 very specific patterns of directional movement that he called waves. And he noted that they are recurring and repetitive in form, but not necessarily in time or amplitude. And he named and defined and illustrated all of these patterns in his notebook, which he ultimately published as the Wave Principle. He basically described in his publication how these structures link together, how they formed larger versions of themselves, and that the patterns themselves were essentially building blocks for patterns of the next larger size. Hence the fractal geometry. If you're not familiar with fractals, it's a self-similar pattern that recurs at larger and larger degrees of trend when we're talking about the market. Think of them as like Russian nesting dolls. The descriptions that constitute a set of empirically derived rules and guidelines for interpreting market action is what is now academically known as the Elliott Wave Principle. So that is the theory. And the chart that we are looking at right now was taken from Elliott Wave Principle. This is a book that was written in 1978 by Robert Prechter and C.J. Frost. And these two fellows were actually fantastic original Elliottians back in the 70s. They kind of rediscovered Elliott Wave and brought it to kind of the level that it's at today with this book that they wrote together, which is, for a long time, it was kind of required reading for the Chartered Market Technician exam. It has been de-emphasized for a lot of different reasons, and most of them are simply the fact that Elliott Wave Principle is really not technical analysis. It's really behavioral finance more than anything. But I think that it fits very, very well with technical analysis. There's a lot of ways that you can utilize technical analysis to verify the conclusions that one determines from this approach to analysis. And and frankly, as a technician myself, I began studying it over 25 years ago, back in 1997, I believe. And I have found it to be critical to my process of market analysis. And I use quite a bit of my approach is derived from technical analysis. So I think it very closely dovetails to modern technical analysis. So let's take a look at just, in fact, before we jump into the next level, I just want to put out a shameless commercial here. And that commercial basically is to inform you about our monthly newsletter. We've been publishing a monthly investment newsletter for almost 2 years now. It's free to subscribe, and it's delivered directly via email to your inbox on the Saturday following the non-farm payroll report each month. So sometimes that's the first Saturday of the month, sometimes it's the second Saturday of the month, but basically in the first half of each month, we deliver a new issue. The newsletter is affectionately entitled Huge Insights, the Big Picture. Therein, we discuss a lot of key macro factors and events that are affecting both the economy and the markets themselves. And we get pretty detailed. Each publication is about 20 or so pages long. We have anywhere between, say, 25 and 30 charts. For those who want to get a little bit more out of this, there's also an option to upgrade to paid, which is as little as $12 a month. That actually includes our monthly market forecast and positioning recommendations. Our paid subscribers also receive our weekly publication called Alpha Insights Idea Generator Lab. That publication actually details our top actionable trade idea each week. It comes out on Wednesday. We also provide some additional updated market commentary in that report. And then we also have some other perks that would include special interim bulletin reports when something really important is going on in the market that we think we want to inform our readers about. And then also we publish some quarterly video content, which is usually a keynote address that we've given at a conference or something like that. It's usually reserved only for institutional investors, but it's a great way to get access to content you wouldn't otherwise have access to through this newsletter. So, please give it some consideration. You can find it on Substack at hugeinsights.substack.com. And with that, I'd like to just really jump into the basic framework of the Elliott Wave Principle. So to begin with, we have to understand that prices have only two wave modes, motive wave and corrective wave. And what the motive wave does is it defines the direction of the trend for prices. And it always unfolds as 5 waves, which makes it easy to distinguish from a corrective wave pattern. The corrective wave form is counter trend. It's a counter trend interruption that allows supply and demand to rebalance, and it always unfolds as a overlapping 3-wave structure, unless it's a triangle, which actually evolves into 5 overlapping waves. And again, very easy to identify because of the overlapping nature of it. Progress itself takes on kind of a specific 5-wave form of the motive wave. You've probably heard, you take 3 steps forward, 2 steps back. That's kind of the same basic principle of the wave form itself. The 3-wave, or I should say 3 of the waves in that kind of forward progress are themselves, they are motive waves. They affect the direction of prices in terms of their trend. They are themselves actually separated by 2 counter trend interruptions. So waves 1, 3, and 5 control the directional movement of the trend. Waves 2 and 4 are those counter trend interruptions, which allow supply and demand to rebalance, okay? And this pattern is a fractal in its nature that recurs at every single degree of trend. So you can see that, waves 1, 2, 3, 4, and 5 that are defined by parentheses also have 5 waves advancing in wave 1, 3 waves retracing in wave 2, 5 waves advancing in wave 3, 3 waves retracing in wave 4, and then finally 5 waves advancing in wave 5. And then once wave 1 is completed, it is followed by a 3-wave pattern, but that 3-wave pattern is also broken down into 5 waves down initially as wave A, 3 waves back retracing as wave B, and then an additional 5 waves down as wave C to complete wave 2 of the next larger degree of advance. Wave 2 would then be followed by wave 3, and the pattern just continues to advance into perpetuity, really, because if we consider human evolution, it is a forward progress event, right? We don't have, backward progress, right? We don't go backwards. We have interruptions, we have counter trends. We had an ice age, okay? We had the Black Death, the Dark Ages. These are counter trend interruptions to human evolution, right? And so, if we think about how the wave pattern unfolds over a very, very long period of time, we can get ever larger degrees of trend in place. In fact, and we'll talk about this in future episodes, but the current state of the market itself is evolving at super cycle and is eventually going to reach a state of grand super cycle. And so we've got these very, very large degree trends that we'll talk about in the next couple of slides here. So let's advance just to the next view here and take a look at how motive waves are formed. So motive waves, as we just discussed, define the directional, the main direction of prices, the trend, if you will. And there are only two forms of motive waves. There's an impulse wave and there's a diagonal. Now, the impulse wave is the most common, and it always unfolds in 5 waves. And it always plays out the same sequence. It's a 5-3-5-3-5 sequence. So 5 waves up, followed by 3 waves back. That's wave 1 and wave 2. 5 waves up is wave 3. 3 waves back is wave 4. 5 waves up is wave 5. That's the end of a motive wave. And so it's fairly easy to identify. Now, if we look at the chart on the left, we can see that this can occur both in bull markets and bear markets. So what we need to understand is that, the impulse itself is not necessarily always going to go up. It defines a change in prices. So when we see 5 waves down, it is an indication that the trend at one larger degree is changing, and we need to be aware of it. And so what we want to do is we want to understand how these patterns evolve, and there's a variety of different ways. We can see what are known as extensions develop, and if we look at the first frame, we can see a first wave extension where wave 1 is subdivided very visibly and observably, and whereas wave 2, 3, 4, and 5 may be less so. And so we see the emphasis of this extension kind of conveyed in the price action of securities or markets, whatever we're analyzing at the time. The third wave extension is the most common. The fifth wave extension is the most common in commodity markets. And the reason for that is because in commodity markets, trends tend to end with fear and greed, right? And so usually in the commodity markets, when prices are going up, it's because you're afraid. There's fear overwhelming the market. The price of oil is rising. I've got to get as much as I can, that sort of thing. And so, we tend to get these sort of extensions in the fifth wave there. In the stock market, it's really the third wave extension that is the one. It's, investors deeply analyze things fundamentally, and we get started kind of gradually, and then eventually things kind of unfold suddenly. And so that third wave is kind of the sudden realization that something is changing, right? And then once the third wave completes, we tend to get something of a lateral consolidation to follow in the fourth wave. And then the fifth wave is usually kind of equal to the first wave, oftentimes. And so a number of things that I think nuances to identifying an impulse pattern revolve around the simple fact that, there's 9 waves, and we might not be able to very specifically identify which one has extended, right? The extension is just not easy to identify. And so as long as we see 9 waves, we know that that's a 5-wave pattern with an extension in it. Okay, so that's where we'll kind of end the discussion on impulses. Let's talk about diagonals now. Diagonals can take on the form of either a leading diagonal in wave 1 or an ending diagonal in wave 5. The leading diagonal unfolds as 5 waves, but it can take on either a 5-3-5-3-5 pattern or a 3-3-3-3-3 pattern, which is unusual. And what makes this very specific to, say, a first wave, wave one's usually going to be the longest, but it only turns out to be 3 waves. And so you can almost start to decide that, this is, if we're beginning a new phase and it's a leading diagonal, we need to be prepared for, kind of a shorter truncated version of a first wave. And so the diagonal that we're looking at in the top frame kind of shows that leading conversion with a 3-3-3-3-3 pattern. And then also in reverse, the same can be true. So in other words, you can have a leading diagonal in a bear market extending down. Now, these can also form reverse wedges. So, the pattern can actually trace out the opposite view, where rather than converging, they expand apart. And we'll get into the nuances of that in future episodes. We also want to talk about the ending diagonal, which also, again, unfolds as 5. And this is where it's much more common. I would say that there's probably a 70% probability that if there's an ending diagonal in a 5-wave advance, it's going to be, or a diagonal at all, it's going to be at the end rather than at the beginning. So it's far more higher probability that a diagonal will show up as an ending diagonal rather than a leading diagonal. But again, ending diagonals always unfold as 5 waves, but the pattern always traces out a 3-3-3-3-3 pattern. Now, both of these varieties can either take on this converging sort of effect like we have illustrated here, or a wedge shape that is kind of the reverse of that, an expanding wedge. And, it makes it pretty easy to identify. And so we think when we see diagonals forming, it gives us a very high probability that the trend is coming toward its terminal phase. And that's what we would want to understand about the diagonal, is it tends to be either the beginning or the end, but usually it shows up at the end of the trend. So the leading diagonal form was actually not part of R.N. Elliott's original work. It was actually discovered and documented by Frost and Prechter, and they published the first evidence of it in their seminal book called Elliott Wave Principle, again, which was published back in 1978. And we highly recommend reading that book, by the way. All of the diagrams in this particular presentation were taken from that book. They're probably the best illustrations for basic illustrations of what Elliott Wave Principle has evolved to can be found in that text. So we will refer to it quite a bit. And with that, that's all the time we have for today's presentation. Next time, we're going to discuss wave degree and notation and the Fibonacci sequence and how it all fits together with Elliott Wave. At this time, though, if you'd like to follow up with me, you can find us on our website at www.jwhinvestment.com. You can also follow me on Twitter at alpha_insights, and check out our website or our newsletter at Substack on hugeinsights.substack.com. And thanks a lot for watching today.